Yeah, good morning. I think it's a function of not just the very near term, but what actually happened last year. At the end of last year, we had some huge moves, of course, in technology companies, a lot of the stay-at-home companies in particular that had benefited from massive subscriber growth. We have seen their stock prices up, 100% and more over the course of the previous 12 to 18 months. And I think what's happening this year is that we're having, as we put it, back to basics. So investors are realizing that we're in a different interest rate regime. Rates are rising. This will impact business models, discount rates. And as a result of that, I think investors are now focusing on individual business models. So perhaps you could argue that some of these stay-at-home stocks, they couldn't possibly continue to grow their subscriptions as they have done. That should not really have been a surprise. But what you're now finding is that investors are now turning to tech companies that have still got very strong business models and are still able to weather this transition to a higher rate environment. Partly, as you say, there's been a function of short positions in there leading to these big swings. But I think more fundamentally, it's simply that investors are repositioning to the areas that they believe are more immune to higher rates and still have a very strong growth prospect.
Guy, it's difficult in the best of times to accurately forecast earnings. And I imagine right now it's harder than ever before. To what extent do you think that this volatility is perhaps a function of the fact that it's really hard to glean where exactly we are in the cycle and earnings are cyclical? How much does that play a role?
Well, I think it's a good point. And this is why I go back to basics again, because all investors, of course, should be focusing on earnings growth, valuations, fundamentals, margins. That's something that we know drives stocks in the long run. In the last couple of years, we have been in this environment where it's been all about liquidity, buying in dips. So I think there is also a regime change in terms of what investors are needing to look at and focus on. And there's no doubt, although we believe, for example, that we're still in the midst of the cycle, economic growth is likely to be robust above trend, but there's no question we're on a declining trajectory there. And that's why when we look at this earnings season, although it's pretty decent broadly, but it's the guidance, it's about what companies are saying about the forward-looking data that I think investors are being so fixated upon, and rightly so. And you can see that impacting the stocks, whether it's a good upbeat guidance they're giving or more cautious, that is being reflected in how these stocks are trading.